Happy Tuesday, everyone. Thanks for joining us yet again here. If this is your first webinar here with Financial Brokerage, I'm Tim Kraus, Head of Sales here, joined by Ryan Patton and I believe Nick Fornaris from Lincoln Financial. I'll let them kind of introduce themselves here in a minute as they will probably do a better job of it than I can. But we're really pleased to be partnering with Lincoln Financial on the topic today. Few housekeeping things before I give you a little bit more information on that. Everybody is on mute right now. That just gives us a cleaner audio. Whether on purpose or incidentally, anytime that we have the lines open, we always end up with some background noise that makes it a little bit distracting. So it's better to be on mute, but that doesn't actually mean that we don't want to hear from you. We do want to hear your questions and comments, and you can use the question function on the right-hand side of the screen to do that. I'll monitor that box throughout. We'll probably let Ryan take the majority of time to go through the topic, and we'll save the questions for the end. But pop those in anytime. I'll see them. If it's something that makes sense to jump in and answer right away, maybe I'll cut Ryan off. See how frustrating that gets for him. No, I'm just kidding. We'll answer the questions as they come in to make sure that we get everybody's questions answered. So, alluding to the topic, this is a topic that I was at a conference last month and kind of wandered into an early bird morning session the first day, and wasn't really prepared for what I heard, because what stood out to me was that life insurance death benefits could be taxable. And that was my big takeaway. Obviously, Ryan will go into a lot more details, but this is a topic that not only is good for you guys to be aware of as advisors, as if you've done planning in this space, and the space that I'm referring to would be the buy-sell space or business planning space, or if you have or if you plan to do planning in that space in the future, also good to be aware of. But beyond that, it's going to be, I think, in my opinion, a great conversation starter from a prospecting perspective with strategic alliance / center of influence type folks, CPAs, estate planning attorneys. This is something that doesn't seem to be widely known about. Ryan and I were just talking about that before the call. I'm guilty of not being aware of it till Ryan brought it to my attention, fortunately. And so great conversation starter to go out and meet with attorneys and estate planning attorneys and anybody else kind of in that space, because it's probably new information to them. So without, I don't want to steal Ryan's thunder. He's the expert on the topic. So I'll kind of shut up there, Ryan, and turn it over to you and let you take it away.
I love it. I love it. I appreciate it. Appreciate everybody being on our call today. Yeah, as we were kind of chatting before the call, this is a very fun topic for me, and a little frightening to say the least as well. So with that, let me go ahead and pop up my screen, and I will get things rolling for you. All right. So yeah, as we kind of alluded, this is a very interesting topic, to say the least, and hopefully that's showing up well for everybody. Let me know if not, but this is a very interesting topic. Yeah. Look good?
Yep, looks great.
Looks
awesome.
Good.
Good deal. But yeah, this is an interesting topic. It's one that I think should be getting publicized a lot more than it probably is. And I wanted to spend a little bit of time today with you just on what are some common buy sells that we're seeing out there, at least over the past 7-8 years or so. That'd be the cross purchase entity, maybe the life insurance LLC as an alternative. And I wanted to set that as kind of the foundation for our discussion. And the reason for that is the next part, that Conley. Conley is a very interesting case that's really throwing a lot of twist into what planning maybe we have on the books, maybe what planning the attorneys are suggesting or what the CPAs are suggesting. This is a wrinkle. And as we kind of alluded to, this is a case that I've worked with a lot of attorneys out there, a lot of CPAs. I was at a CPA symposium this past fall, And I would say a majority of the CPAs weren't even aware of it. So it's pretty frightening. Gives you a great opportunity to have some meaningful discussions, not just with your current clients or potential clients, but also those centers of influence, as we were saying. And then from there, I wanted to chat about, now that we know a little bit about this case, how do we integrate that into our estate planning? What does that change for us? And then maybe some next steps too. So it'll be jam-packed, but hopefully we have some good discussions too. So as we kind of alluded to, this is kind of our flow for at least the opening discussion. I wanted to cover just some of the basics around some of the common buy-sell techniques that we use today, and ones that we may pivot to a little bit more given this Conley case. So we'll cover entity or redemption style buy-sell just briefly, cross-purchase, trust deed or escrowed. You might hear of that time to time. And then that elusive newer style buy-sell, that life insurance LLC. So with that, I thought we'd kick things off with the entity style. And the reason I wanted to kick things off with the entity style is this is the one that was head of discussion for the Conleys. So as you could expect with entity style or redemption style, a lot of folks default to this. A lot of individuals that have buy-sell arrangements today have generally a provision within that agreement that says, we're going to let the shareholders have the option to purchase first, but if they don't want to, we're going to stick it to the business, for lack of better terms. We're going to stick it to the business. They have to buy us out. So they have to have that redemption in place. And a lot of folks honestly probably default to the actual entity style just because it's a little simpler. The business is going to facilitate everything. It keeps away, this owner owning a policy maybe here or there on different owners. It tends to keep things pretty simple. A business is going to be the owner of the insurance, the payer of the insurance, the beneficiary of the insurance, and it really helps for a couple of different reasons. And I would say the top 4 things that I tend to look for are these when it comes to entity style. If I'm a seller of the business, I'm looking to get out, what's my seller's tax? How do I mitigate that, or how do I manage that? If I'm a remaining owner or a potential purchaser, what's my basis? Does that become affected by some of this entity style? Shifting control is pretty big, especially if you're working with closely owned, maybe family businesses. Maybe you've got somebody there that we'll touch on, and then asset protection too. So just real quick on the seller's tax, this is a pretty big one. If I am a departing owner and I'm looking to walk away from the business, what could I expect my taxation to be? If we have an entity style arrangement, this is where it gets a little interesting. If we have A and B as our case here, and we've got that kind of value of $100, am I going to get the $50 back out of the business? $40 of gain, $10 of basis. Am I going to get that back as capital gain? There is a chance you might not. There's a chance it might be treated as a dividend. There's a chance it might be treated as ordinary income for part of it. So this is a very big discussion when we have this type of arrangement, when we know the business is going to buy back those shares from the owner. Always focus on that seller's tax. It depends on the type of business, but it's one of those top 4 things to be aware of. The other one is that purchaser's basis. This is another very interesting discussion. Whenever we have the business buying out a departing owner, we're going to shift over their interest in the business to the remaining owners. The thing that could happen, and this is notorious for those C Corps out there, which tend to have these types of arrangements, those C Corps, if the business is buying back the interest of that departing owner, everybody else that is now an increased owner doesn't get a step up in their basis. So if it were just, say, me and Tim in this business, and we had the business buying out and we're 50-50, just like that last slide where we had $10 of basis, if I bought out his basis, my basis would have improved a little bit. Where here, with the entity doing it, I get no step up. So if I know I'm going to depart in the future, still going to have a lot of tax that I might have been able to mitigate had I had some sort of just direct purchase, say from Tim. So very interesting. If you're working with a a pass-through business like a partnership, S Corp, something like that, then we might have a little bit of basis adjustment. But again, this is a really big one when you're thinking of, should I do an entity purchase redemption style? The other one is that shifting control. This one is pretty big for me when you're working with those closely owned family businesses in particular. Say you've got somebody that's a minority owner today, and now we've got a departing owner, and we're shifting some of that ownership interest to the remaining individuals. Well, now we used to been able to push this individual's thoughts kind of towards the door, but now they're empowered. They've got a little bit more control, and we might actually have to, vet some of their ideas. We might have to have a true vote on certain aspects that we wouldn't have had to before. It can get very interesting. And so shifting control is a big one with entity style. That one can sneak up on you pretty quick, especially if you have kind of a larger group of owners. And then the last one is just asset protection. If we own the policies in the business, that offers a little bit of a wrapper from a protection standpoint. So always one that we tend to favor. And again, that's one that we can stretch a little bit even farther as well into maybe bonding. If we're a construction group, we might be able to use the assets on the books of the business. So top four, didn't want to dive too deep. Happy to dive deeper in maybe an offline discussion, but those are my top four from an entity purchase perspective. I wanted to give you a little taste of the other big type of agreement that we tend to see most often, and that is cross purchase. Cross purchase is not a bad thing for closely owned businesses where you have a few owners of the business. Here, the biggest distinction is everything from a buy-sell perspective is outside of the business. So if we have owner A and B, we're going to own policies on the other individuals individually. So everything's outside of the business. We're paying for it. We run the risk of default. And as you can probably see or expect, one of the big things that I think is, purchaser's default. If I own one on Tim and I just happen to forget, to make a few payments, or I just don't want to pay into it anymore, and Tim passes away, I'm still on the hook to buy out his interest, but I've got no money. So how do we deal with that from an estate perspective? Very interesting dilemma there, a lot of risk. The other one's policy count. As you could probably see on that last slide, it gets pretty nasty pretty quick. If we have 4 owners, I have to own, as one of the owners, I'd have to own a policy on the other 3 owners. And that would be all 4 of us doing that. So just imagine the administration, things like that. Cash flow and insurance, maybe some disparity too, is another big reason cross purchase might not seem as attractive. And these are what I wanted to give you from a purchaser's default. So again, we've got the same situation. A and B are owners. Biggest issue here is if B passes away and A is going to be the remaining owner, what happens if I just failed to pay those payments? Especially if I've got a group of owners where we have 4 owners and I've got individually 3 policies to manage on their individual lives, keeping up on their performance from an insurance perspective, that gets pretty daunting. I might forget to make a payment. I might, adjust the policies incorrectly. There's just a lot of risk from that perspective. And as you get more owners, that becomes more burdensome, more complex. And if they're running the business as a closely owned business, insurance tends to be one that we put on the back burner as opposed to something that's front and center, front of mind, that is. So purchaser's default, very big risk that is present with these agreements. The other one that I think is very large, and which we already touched on, is that policy count. I mean, just this scenario that's on the screen right in front of us, that would require 12 policies. So pretty daunting, a lot of checks going here and there, and maybe different issue dates, not a consistent, just one payment coming from the business to fund these. It's a little bit of a mess. And so the other one is cash flow too. If I have different ownership interest, how do I get the money to the individuals to purchase this outside of the business efficiently? If I have owner A that's 30% ownership as opposed to owner C that's 15%, can I take a distribution for that payment? Would I have to increase the W-2 wages of owner C? A lot of challenges from an accounting perspective that go into this type of arrangement as well. And that also goes with that insurability and disparity. Say we've got owner D that's our largest owner, and they're also a little rougher on the insurability spectrum. So we have a large amount of money that's got to go towards their policies, as opposed to maybe owner C that's younger, fresher into the business. Their policy is not going to cost much. And what if owner B isn't even insurable? That's another issue you run into with this situation as well. So those are my top four. Again, we can dive deeper into this, but I wanted to really focus on that Conley case and how it affects these planning as well. But I wanted to give you the other two as well that you might run into. Trusteed or escrowed. I tend to see at least 1, 2, 3 of these every probably 6 months or so. These are essentially a really nice tool if you think that there could be conflict within the family of that surviving or departing individual's ownership interest. This is where a trustee is going to facilitate everything that you've agreed to within your master buy-sell. So whether that's an entity style, whether that's a cross purchase, the trustee is going to step in and say, I've got it taken care of. I might even own the shares of or have control of some of the shares of stock. I might be the owner to a certain degree of the actual insurance. I'm going to be the one responsible to facilitate the buy sell when an event happens. So it's great from that perspective. It keeps things a little simpler, but as you can imagine, if we have a trustee stepping in place, they're going to have a fee as well. So know that this is an option, especially if you're running into a family situation or a closely owned business situation where you might have a degree of conflict with that surviving individual's spouse or family. So good option though. Wanted you to be aware of just a high level. And then this is one that I think comes up more often. I just had a call actually yesterday on this topic for a group of car dealerships. The life insurance LLC is actually, it's taxed as a partnership. And this is a separate entity from the operational side of the business where we have the actual buy sell. This is just an entity to facilitate really the funding of the life insurance. It gives us a lot of flexibility, and it also gives us the perks of an entity style. So reduced policy count, all those nice perks there, with the perks of cross purchase. So when the funds come into this LLC, we distribute that out to the surviving members. We're going to use that to purchase from the estate, the individuals are from the estate, their interest in the business. So that gives us step up in basis, but it also allows us, if I just want to leave the business, retire right off into the sunset, I'm actually able to take this policy from the business and potentially not have a taxable event. So as opposed to maybe our C Corps or S Corps that we have that entity style today, if I want to take a policy that's in the business with me in retirement for estate planning or whatever the case is, the S Corp or C Corp has to realize gain in the policy prior to you taking it out. So nasty tax situation we don't want to see folks deal with. So life insurance LLC, very popular and one that we might pivot to given this Conley case we're going to talk to. But these are my top four. So know that you'll probably see these pretty often. You probably work with them quite a bit. But what I wanted to spend a bulk of our time on today is this Conley case. So a little bit of background. Yeah.
Hey, sorry, quick question that came up, and I think it'd probably be good to get to this one before you get into the Connolly case.
Yeah.
It was related to pretty much the last slide, I think. It says, please explain, married couple would like to have life insurance policies in LLC name. They have the cash flows to buy the business. What are the pros and the cons, and are those premiums tax deductible?
Yeah, good question. So this is going to be for your business owners. So if we have those, say owner A, B, C, D, we've got a multi-ownership group. Kind of the general flow of this is going to be a separate entity. Each year we already have kind of our overall buy-sell need with the actual operations. So say it's $10 million, and we've got those 4 owners. So we need $2.5 million per person for the actual buy sell with the main entity. So each year, those owners, A, B, C, D, are going to contribute to this life insurance LLC enough premium to pay for those policies. That can be equal across A, B, C, D. It could be matching what their actual ownership interest is in the real operational entity, but it's a little bit flexible there as well. But those contributions, no tax issues there. It's almost like we're contributing cash to the business, and it's going to sit in that business until we have an event where we need to pull that money out. So retirement, we could pull the money out in the form of the life insurance contract on our lives, or one of the individuals passes away, we're able to pull down those death benefits tax-free too. So it's a nice vehicle. There's no tax deduction for that, for putting it into the business. It'd just be the same as if you're contributing to your actual business today. So no big tax benefit there. The biggest tax benefit is in the form of that distribution. So if I want to take the policy out in retirement, great. No taxation, because really it's just a return of my contributions to the business, to that LLC. So I'm able to pull it out there. And death benefit, what would happen there is the death benefit's going to flow into the life insurance LLC. That's actually going to act to increase the overall capital position that you have in the business. And in doing so, it's tax-free. So it increases your capital position within that LLC. You're able to pull that out tax-free. So it's got a lot of really nice perks. And it's got the nice benefit of the business doing everything for you. So only 4 policies in our example there are going to be needed because the business is going to own it and facilitate it. So a lot of perks there, but pulling that money out gives us that ability to then purchase from the estate of that deceased owner those shares that they had directly. So we're able to step them up to that fair market value of the 2.5 million in our example, instead of us still having that initial basis in the company when we first started it, which may be next to nothing. So it's a really nice mechanism to get a lot of the perks of cross purchase and entity style. So I hope that helps explain that a little bit more. What I'll do,
Yeah.
Tim, is I'll send you over a piece that details this out really, really well. It was a local law group that put it together. Do a really, really good job.
Yeah, absolutely. And I'll make sure that I get that out to the group. And thanks again for the question, and excited to hear about the next part.
Yeah. And this is where things get interesting. So this is where I think, gosh, if I had hair, I'd probably lose it. It's frightening to me. This Conley case, I'll give you a little background on it. We had Michael Conley, and he is the majority owner, 77%, a little north of that, majority owner of this business. He is the operator. He's the main one that's running the show. He's got a son that's going to take over the business as well. Given his kind of active ownership, that's kind of the transition or the succession plan. Thomas is more of the silent brother to this operation. He's there. He's not as active as Michael is, certainly. But being brothers and being in business together, Thomas is the one that's going to help facilitate the actual buy-sell agreement, some of the estate administration. So think of all those closely owned businesses that you've got. Same sort of scenario here. What we had in this business is they wanted to keep it simple, so they had an entity style. So the business purchased insurance on Michael. That death benefit, Michael passed away. We redeemed all of Michael's shares in the business. So Thomas was a facilitator of this. Death benefit came into the business, 3.5 million. And what the result was is they failed to do a few things. And you can see it on the bottom left there. They failed to comply with this 2703, which is what really binds the IRS to a buy-sell and the valuation of that as well. They failed to do a real valuation, and I'm not talking a formal, go get a very formal valuation where you're spending a lot of money. They failed to just have that certificate of agreed value that they attached to the back of their business meetings each year. What happened was Thomas said, I think that sounds about right. 3.5 million we got in on Michael. That sounds about right for his interest. That's going to be the value. So the IRS, as we'll see in the next slide, the IRS said that doesn't seem like it feels good. So we're actually going to take that death benefit, although it's tax-free, we're going to take that and add it to the overall value of the business for estate tax purposes. So Michael's interest isn't just going to be his value in the $3.8 million business, it's also going to be the value of the life insurance added to it. So pretty frightening from our perspective. We always view that life insurance coming into the business as a way to mitigate risk. The business has an obligation to buy back Michael's shares. That's a risk. So we're offsetting that risk with insurance. Here, the IRS said, that doesn't seem right. What they actually said was this top kind of 2 o'clock on my dial here, they said that life insurance almost acted as a way to transfer property to the family for less than full and adequate consideration. So very scary. And it just makes me think, this case under 7 million, not a big issue. But if you're working in a state where you have state estate taxes, state inheritance taxes, we know sunset of the current tax law is going to happen fairly soon. If you're working with a business that's worth 10 million and we have 5 million on the two owners like we do here, that's pretty frightening. We went from a $10 million business and now we're adding on 5 million at death. That can be very frightening as we're heading into this estate uncertainty. But what the Conley court case said, they said, these are the actual requirements if you want us to be bound by your buy-sell. So it's got to be a bona fide arrangement, something that's kind of that arm's length transaction. It's got to have a reason for it. It's got to be legally binding. We have to have some sort of way that is determinable to assess value of your business. They had some of that within this case, but what they really had was a little bit of flexibility. They had what you would tend to see as kind of a wait and see buy sell, where we're going to have maybe an appraiser come in, but they never did. They never did that. They had what I tend to refer to as most closely owned businesses, the musty and dusty buy sell. We're going to do it with the attorney, and then we're going to put it on the bookshelf and leave it sit there for the remainder of time until we need it. So they weren't following the things that they really needed to, but that's a lot of closely owned businesses. And the thing that really makes me nervous with this case is it's not the first. This is actually the second court case that we've had fairly recently. The first one that was bigger was Blout, and Blout was actually overturned. Imagine that, a group of attorneys, maybe some life insurance attorneys, who knows, but they fought for this and they wanted to remain, in a nice tax position. I have almost no doubt that the same sort of scenario is going to happen with Conley. I'm sure it's being appealed as we speak, and I'm sure that's going to probably be in the favor of the Conleys. But the thing that scares me is this was round 2. And from our perspective, and I know Nick's on the line, I don't want anything that's Lincoln related to be number 3. So we want to take the steps to avoid this scenario altogether. And the reason it's a little challenging from that perspective is the court actually came back and said, when it relates to this 2703 provision, the statutory requirements for a buy-sell, some things we actually favor. So preservation of a family business, that's bona fide. That's a real reason to have a buy-sell. Discounts, minority control, some of those interests that we discussed already, they said that's another great reason. But anything that's family related, they're going to have extra scrutiny. We want to make sure that you're following the rules, so we're not just acting as a way to transfer additional wealth through the family. But they had a couple of real good reasons why this is so important. And from our perspective, what does that mean? It gives us a lot of really good opportunities to have some strong discussions around, hey, I noticed you have a buy-sell in place. Have you had a valuation given this Conley case recently, an informal business valuation? We're happy to do those for you. Have you had a buy-sell review given this Conley case? It came out at the end of 2021. So I would say most folks probably not. So great opportunity to have a simple opener and say, have you had a business buy-sell review given this Conley case? Just happened at the end of the year. Have you talked to your attorney about it? We're happy to have those discussions, even with your attorney, to make sure you're compliant and know that this case could affect you. So great opportunity. It's non-confrontational. It really just sets them up to make sure the things that maybe you did put in place are still compliant with this kind of nasty outcome. So with that, knowing the fear of that case, what do we do from an estate integration perspective? I think there's a few really good opportunities. And one of the ones I think is very key is that center one at the bottom. So estate equalization. I see a lot of individuals that'll have closely owned business where we have one, maybe two individuals that are going to be actively participating in the business. But, and think of a great example of this is kind of the farming scenario where we've got one or two active children where the other ones are more passive or they went off to the city. If we have any sort of estate equalization concerns and we have any sort of ownership in the business or potential ownership in the business that's going to be family related, estate equalization could come into this as well, especially if we think I'm going to give them shares, but the business is going to actually just have the mechanism to buy them out. I've seen that a few times, and I think that runs a potential risk with this Conley case. And the big thing for me, and this is my attempt at being creative with slides, is anything we do, we want to mirror. So the mirror in the back of this picture was my hopeful attempt at making my slides better, but anything we do with the business entity itself, we want it to mirror what they're doing with their trust, with their wills. Anything to that degree could run afoul with, I believe, some of the Conley as well, just because are we acting as a way, did I gift within my trust the actual shares of the business outside of, or maybe even in compliance with some of the language in my bylaws or my operating agreement? Did I take a step to deviate from that? That could be a potential issue with this Conley case. So I'll leave you with a few next steps, and then any questions you've got as well, I'm happy to answer. But I wanted to give you, some of those who to go after. And I wanted to give you a couple of fun things to maybe suggest as alternatives. So the biggest one that I would say to pivot to, what are we looking to pivot to given this Conley case, given the issues with entity style, especially with closely owned family businesses? I would say the general pivot is, at least from the CPAs and attorneys I've partnered with, is a pivot to cross purchase if it's practical. Meaning we only have maybe 3 owners, maybe 4 at best, but the administration is pretty challenging. That risk of default's pretty heavy. So cross purchase maybe, or we're going to pivot to that life insurance LLC. The reason for that pivot, even though it is entity style, the only thing that's in that business is going to be the life insurance. And the facilitation of that is a little simpler than your traditional master entity, because the master entity, we have a set value for that business, where our life insurance LLC, it's really, the value is really just our contributions to the business, because that's all that's in the business. So look to those 2 pivots, cross purchase, good set of rules to go by, and then that life insurance LLC, good alternative there as well. But look for those businesses that are closely owned, family businesses. So walk down Main Street, that sort of approach. And I would say the ones that are very big, there's a little over 2.2 million farms in the US. 98% are family owned businesses. And a majority of those are older businesses because mom and dad still own it, meaning that they likely have a C Corp on the books or maybe an S Corp on the books that has an entity style buy sell. So look to those. The one that I would say to pivot to as well is, instead of having the business facilitate maybe those non-active owners being bought out, look to estate equalization. That's a great option as far as getting out of the business, doing some things foundationally through their trust, through life insurance as well, as a great pivot. And then a fun provision that I'm sure has a more legality name than what I've got here, Texas shootout provision. So if mom and dad are concerned that, the reason we have it within the business entity itself is we know the rules, we've set up certain terms from a buyout, we want our son or daughter that's not active in the business to be treated fairly. The Texas shootout provisions, one you could put in your trust. And that essentially is a provision that says, if I'm going to offer to maybe a passive owner a certain rate to buy their shares, I have to acknowledge that that offer that I give to them, they can turn around and buy me out for that same offer. So it gives a little more assurance that we're giving a fair price if we're going to do things outside of the business. So Texas shootout provision, feel free to bring it up to the attorneys. They might say, "Where did you hear that?" Tell them it was an Ohio guy that said that. But great alternative from a planning perspective. But look to those, use those as great options. Uh, Combing through your books and really leverage this case as a way for those centers of influence, as Tim kind of alluded to at the beginning, is we know that certain CPAs aren't aware of this today. We know attorneys aren't aware of this. So make them aware, have them go through their book as well as a great prospecting tool and just a great way to add value to your centers of influence and your clients too. Great opportunity to do some business planning. But with that, I know I've said quite a bit, so I want to open it up for any questions that have come up or anything else I can do.
Sure, absolutely, yeah. And we did have another question going back to the life insurance LLC and taxation. So, I thought LLC rates might be higher than individual tax rates. Are we sure it's a good investment to invest in an LLC instead of paying from an individual bank account with no benefit of the tax deduction?
Yeah, so I mean, there's still going to be no deduction purchasing the life insurance, even if you do it individually. So the LLC is almost the same as if you're going to buy it individually. Because if I contribute 20,000 to the LLC to purchase the policy, I can then go ahead that same year and pull that policy out to me tax free. So I've got that flexibility to pull or push products or financial into that LLC. So it's nice from that perspective. Uh, so taxation wise, no big deductions, no big reasons for that. The nice thing is if I do own it individually, I run the risk of the other individuals owning it individually as well. And their assurance that they're going to pay for it, that sounds great, but maybe they don't. Or if we want to pull those policies back to me in the future, I would have to actually buy that policy from the other individual that owns it on my life. Where the LLC, if it's the owner, I can pull it out tax-free, not have to worry about transfer of value. I've got a lot of really nice perks on that side. But great question.
Yeah, absolutely. And then just a reminder to everybody, if you do have a question, go ahead and use that question function on the right-hand side, drop it in there. As I've now proven, I will see those questions come through. So, and I want to give while we're waiting for questions, I want to give a shout out to Lincoln Financial because I can say from my position in the IMO space, I have not had any other carriers reach out about this concept. So obviously, Lincoln Financial is showing their expertise not only in the traditional methods of planning for buy-sell and estate planning business cases, but obviously they've kept up to date with what's going on and they're aware of what's going on in the marketplace. And so it's not just about knowing the traditional methods or having those plans put in place in the past and having those be secure plans when they were put in place, but staying up to date on what's going on with it. And so I give a shout out to any of you working in the buy sell place, whether or not it relates to a closely held family business or not. You want to run your ideas by. You want to get some consultation on what might be some of the best planning methods for a buy sell case. Certainly contact us and we can coordinate with Lincoln Financial so that you can get that expertise and make sure that you feel confident in putting together those cases for your clients.
Hey, Tim.
Yeah,
Tim,
go
I don't
ahead.
know if you can hear me. This is Nick.
Yeah.
I wanted to toss something else over to Ryan that maybe you could address. You mentioned that certificate of value and all that. You mentioned, how your business is valued after the pandemic with PPP loans that were forgiven and with ERC credits and, with the change in all these changes. Ryan, could you speak for just a minute about one of the other services that you actually can offer to our advisors and their clients? That of an actual informal business valuation?
Yeah, happy to. So that's a really good pivot to use this Conley case to get in there as well. So informal business valuation, I think, is a really hot topic, just given Conley case, as we just covered, all the things that Nick just brought up, PPP loans, all the other CARES related money that went into businesses, a lot of changes just overall to businesses coming out of the pandemic too. So it's a great opportunity to provide an additional service of, has anybody offered you an informal valuation given all the changes you've gone through over the past few years? A great way to see if their coverage is adequate, great way to see if they're doing the things that their peers are doing as well. And as you can probably see by now, I'm a little bit of a tax geek. So if there's anything that I see from a tax perspective that maybe they're doing or maybe they're not doing, say it's a business and maybe they're not paying themselves in the way that's the most efficient way, maybe I should take distributions as opposed to W-2 wages, something to that degree, we'll let you know any of those items as well. So it's a really good service, and it's a really great way to prospect within maybe a banking relationship that you have. Go to those bankers because they have all the things, as Nick mentioned, the PPP recipients, they've got a list, and they're looking for reasons to reach out to those clients to stay top of mind when it comes to their lending. Ask them, hey, have you offered a informal business valuation to those recipients of PPP loans to see where they're at given their participation with that program? Great way for you to get in, add that value added service. So yeah, certainly use us for that as well. Buy, sell reviews, and anything you want to chat about and who you want to chat with as well. So CPAs, attorneys, I'm happy to be on the call with you, even the client too.
Yeah, great point, Nick, and thanks, Ryan, too. You know, a very easy prospecting question for business owners that might not make you super popular at parties, but you know, is your business valuation up to date for your buy-sell agreement? And one of three things are going to happen. You know, one, they might be say, what's a buy-sell agreement? That's an opportunity. Two, you know, well, actually, no, it's not. It doesn't need to be. There's an opportunity. Or number three, they can say, yes, it is, and great. They've already got the planning done to take place. So great point, Nick, and thanks, Ryan, for going into that. We did not get any other questions to come through. I know, Ryan, you mentioned that one-piece document. I think there's some interest in that. So if you send that over to me, I'll make sure that I get it over to this group that was on the call today as well. Other than that, that wraps it up for me. Any final comments, Ryan or Nick?
No, I appreciate the opportunity. Yeah, as always, great partnership. So anything we can do to help you, let us know.
Absolutely. Thanks for taking the time today. Appreciate it.
Great. Well, thanks, everyone.
All right. Bye.